Signatures.
Signatures. And what does the signature create?
Well, permission to contract in commerce.
It's evidence of a debt, usually.
Okay.
So we pass money around. The money we use is debt, right? A check is evidence of a debt. If I sign the check and I give it to, and I write it to you, it's evidence that I owe you money. Okay. So what happens with the Federal Reserve and your bank when you deposit funds is if you endorse a check and deposit it into your bank account, and this is straight from the Federal Reserve, okay, your check goes to the bank, or you deposit your check endorsed to the bank. The bank gives you a, let's say it's a $1,000 check. This pen is broken. I need a new black. Okay. Thanks. That's cool. I'm going to do the liability side first. So how many are familiar with double entry bookkeeping? Okay, for every asset, there's a liability. Okay. Right here is a $1,000 liability for the bank is created. The bank sends the check over to the Federal Reserve. Everybody know how money is created?
Signatures.
Signatures. And what does the signature create?
Well, permission to contract in commerce.
It's evidence of a debt, usually.
Okay.
So we pass money around. The money we use is debt, right? A check is evidence of a debt. If I sign the check and I give it to, and I write it to you, it's evidence that I owe you money. Okay. So what happens with the Federal Reserve and your bank when you deposit funds is if you endorse a check and deposit it into your bank account, and this is straight from the Federal Reserve, okay, your check goes to the bank, or you deposit your check endorsed to the bank. The bank gives you a, let's say it's a $1,000 check. This pen is broken. I need a new black. Okay. Thanks. That's cool. I'm going to do the liability side first. So how many are familiar with double entry bookkeeping? Okay, for every asset, there's a liability. Okay. Right here is a $1,000 liability for the bank is created. The bank sends the check over to the Federal Reserve. Let's see if we can fit all the ledgers on here. Federal. Okay. Right. Okay, so bank sends the check over to the Federal Reserve. Federal Reserve says, okay, go ahead and put a temporary credit right here. Okay, for every asset, which is in black. Did you give me a new one? That was the new one. That was the new one? Yeah. Okay. I'm good. Don't mess with the mics. Yeah, no, I will need a new one. This one sucks. All right, we're just going to write in red. Stay away from that thing. All right, so $1,000 asset, which is the security the check itself. Now, what happens is the Federal Reserve holds over here the bank's account. See, the bank itself has an account over at the Federal Reserve. You've heard of reserves, that we're on a fractional reserve system. Well, whatever's over here in the bank's account, this side is a liability to the Federal Reserve, but the Federal Reserve holds an asset over here to offset that. Okay? So, you have this credit is the same as this liability. It's a credit for the bank. It counts as their reserves, so they can fractionalize it 10 times, okay, and accept loans based on that. So you have your $1,000 in an liability account at the Federal Reserve, which is the reserves of the bank, is the same as the assets over here in the bank's ledger. So on the bank's on their ledger, it's an asset. On the Federal Reserve's ledger, that money is a liability. So now the Federal Reserve gets the check, and they notice that it's from Bank C. Okay? So they debit Bank C's liability account, or the Federal Reserve's liability, Bank C's asset account, which reduces their reserves by 1,000. Whenever a bank's reserves get reduced, it must reduce its deposits by equal amount. So the bank is now put into a position where it must reduce its reserves by $1,000. So what does it do? It reduces your account by $1,000. It says, hey, since you're the guy who authorized that check, we're going to reduce your account down to 1,000. Okay? So, is the check itself money? No. It is. I'm here to tell you, it is. It's got a signature on it. It's a negotiable instrument. It's money. Okay? So, $1,000 endorsed check went in here. The credits got put on temporary hold here. When the bank when Federal Reserve went to this bank and said, hey, we're going to reduce it for 1,000, is that okay? And they look at the account number, they go, yeah, that guy's got $1,000 in there, go ahead. So they reduced the account. Now there would be another ledger over here for Bank C, and Bank C would list this money as an asset. And it would have deposits over there that it just reduced by 1,000. Okay? So, that's what happens when you deposit a check. Oh, man. And this black doesn't erase either. Yeah.
So it's a number. After the signature, it's a number until it actually hits the place that it's going, and then it turns into money.
It's money the moment you sign it.
So it's a note.
Now remember, all we showed was the bank's ledger.
Yeah.
You have your own ledger.
Yeah.
Okay? Your trust, your corporation has its own ledger. It was on the books of your trust until you deposed yourself of the funds and gave it up to the bank. Okay? Now, whoever wrote you the check, the check itself ends up over at their bank eventually. You remember back before 2000 they used to send you your checks back?
Yes.
When was the end of the last bankruptcy? 1999? Okay, you know why they don't send you your checks back anymore? They're securities. Now, what? So, here, now we're moving over here, we were dealing with Bank A and the Federal Reserve. Now we're going to come over to Bank B and show what happened with that same check. Okay? So over here at Bank B, we're going to put two ledgers. And we're actually going to leave the Federal Reserve out of this because you saw what happens at the Federal Reserve for Bank B. So Bank B, this is the deposit account, so to speak. It went negative 1,000 for Brenda when she, or for Dylan when he sent Brenda his child support check. So this account went down 1,000. The check itself is a security. Now, a security is an asset to the bank. Okay? So it gets ledgered over here as an asset. However, It is not in the Federal Reserve account. Remember, what they can leverage is what's credit on their Federal Reserve account. So this is being held in an escrow account at the bank, this $1,000 check as an asset. But there's no liability funds over here for it, so it's just sitting there. Now, a bank can sell, when a bank needs capital or it needs reserves, according to the Federal Reserve, there's one way a bank can increase its reserves: selling securities. So the bank can sell the security. Who are they going to sell it to? Federal Reserve. Who's the Federal Reserve going to get the funds from? Treasury. Okay? So, and this, like I said, follow modern money mechanics, and you'll see the flow of funds and how it's moving. Okay, now this check is sitting over here. Your account, you're Brenda, and your account's been reduced by $1,000, right? And your bank is holding this security up here, okay? This security has a face value. The face value of the security is whatever you wrote in on the amount of the check, okay? That security is actually your property. The way the bank gets away with selling it is they have to wait what's called a testing time, or a testing period, which is 36 months, according to the IRS, before they can declare it abandoned. Then they can sell it and increase their reserves. Okay? So, because they've got this $1,000 security, at the end of the year, Brenda goes to do her taxes. And she remembers that security she created, and all of a sudden she remembers that the bank never sent it back. She did not get her security back. So, what happened? It's an original issue discount is what happened. The original issue was Brenda writing the check. Brenda wrote the check to Dylan, Dylan deposited it. So, Brenda wrote the check ended up back in this escrow account, okay? So, the definition of original issue discount is the redemption value minus the issue price, okay? How much did Brenda's bank pay her for that $1,000 security?
Nothing.
Nothing. What's the redemption value? $1,000. So what's the original issue discount?
$1,000.
And if the original issue discount is $1,000, did they give her the $1,000? No. So it's been withheld. Okay? If you look at your if you look at your 1099 OID, there's information for the payer, information for the recipient, an account number. Box number 1 is the original issue discount. Now let's say that that's the only check Brenda wrote that year.
We got some new marks for last year.
Okay. If that's the only check Brenda wrote that year, then there's $1,000 in box 1, because that's the original issue discount. Okay? Now, seeing as Brenda's not a financial institution and didn't put any interest terms or anything on the instrument, she didn't write, 5% in 2 years or nothing like that. She just wrote $1,000 on the check. So, box 2 and 3, which box 2 is periodic interest and box 3 is early withdrawal penalty. None of those exist, so they would be zeros on the form. Box number 4, federal income tax withheld. What is the federal income tax withheld on this particular transaction? $1,000. Okay? So the $1,000 of the original issue discount, which is the redemption price or redemption value minus the issue price. Okay, that's the original issue discount. And the amount withheld is how much did they hold on to that they didn't give you? And they didn't give you any of it, so they withheld the entire amount, $1,000. So, box 4 is the same as box 1, the total amount of original issue discount, if it's all been withheld.
Can you explain how that $1,000 is defined as a federal income tax?
Can I, how it's defined as a federal income
Yeah,
tax?
how is
Because
it a federal income tax?
the bank itself is withholding a tax. For instance, if the money is due to you, you're the original issuer, that's the redemption price, and they paid nothing for it. So basically, since they're withholding those funds, they're acting as an agent for Internal Revenue on those funds. And if they wait the 3 years, they get to sell that security. Now, then they'll pay the tax on it. But until those 3 years are up, it's probably just sitting there. Okay? Yeah.
What if you have a joint account? Then what happens then?
If you have a joint
Joint account with
account,
somebody
it
else.
doesn't matter because each person is authorizing the funds. It depends on whether you file a joint 1040. Is it
Wait for the mic before you ask your question.
Oh, sorry. Okay, so what if the joint person passed away? Then do you just file yourself?
You could. How would you file? How would you file your 1040 as a widower?
I don't know.
See, the thing is, when you have a joint account, typically you're married. Is it a situation where the parties are married or no?
No.
Okay. So it's a joint account. Neither is married. Some parties are writing checks. Some like both parties are writing checks.
Yes.
Okay. So realistically, you're both creating the credit each time. So it depends on how you're going to file your 1040. Is she going to declare original issue discount? And if she is, which checks is she declaring? Is she only declaring the ones she signed? If so, that's fine. Realistically, you can both sign for the full amounts on each, as long as the other doesn't. So if one person's going to file all the OID, that's fine, because you're a signer on the account. Whether it was your signature or not, you're an authorized representative on that account.
Oh, so sorry.
So for past checks that she wrote and we're joint, I can claim those checks that she wrote because I'm joint on it?
Yes. Were you joint on the account at the time?
Yes.
Yes. Because realistically, you're both agents of the account, and you're both trustees on the account. So the funds need to be claimed back if the person's deceased. If the person's deceased, then there's no way for them to claim it back. So you'd have to claim it back. Otherwise, you're letting it sit. See, what happens if you don't claim this back? You just created debt.
In the world.
Yes. Okay, this security outstanding and not coming back to you creates debt. Every time you spend money in public, you're creating debt. If you don't get it back, the debt just gets bigger and bigger. So people, I know, like to ask the question, well, how much is out there that we could get back? And in reality, how much debt have you created? It's at about $10 trillion right now. That's how much debt we've created. Okay? And we've never claimed any of it back. Well, I take that back. Some people have been doing this since the 50s and 60s, getting these funds back in different ways. But realistically, the modern movement, I would say late 80s, or late 90s, really, for the OID end of this. So since the late 90s, there's been a lot of people claiming the funds back, but not enough to reduce the debt significantly. Microphone.
Wait till you have the mic.
How many years back can you go if you have a box full of old checks? What are those?
What's the testing time?
36 months.
36 months. After 36 months, this shit's gone. It ain't
What if
there
you're
anymore.
holding the original checks?
It doesn't matter.
Okay.
Oh, wait, you have the original checks?
Right, before.
Well, you were supposed to send those to Treasury. See, now you're not in the same position. So they're doing you a favor by keeping the checks. See, when they sent the checks back to you, well, now you got to send them to Treasury, and it'll credit your account. But it's better for them to hold it and let them deal with the Federal Reserve and Treasury.
So you're talking strictly, is this a physical checks only? Or if you're
No.
paying out of like my
Well,
auto You
That-
know, like
that-
just paying out of my online account to Visa.
Okay, so how did you pay?
I just click the box that says pay Visa $500 and
So
say,
what was it, a debit card transaction?
well, just out of my checking account. Electronic
Transaction?
Electronic.
EFT, is that what they call it? ACH? You put your account number in?
Yeah.
Okay,
It's right out of my checking account, so it's
okay.
Union Bank.
Any transaction you authorize out of that account creates a security. Okay, back in the day, everything literally had a written security with a signature on it. Remember, even to get cash withdrawals before ATM machines, didn't you have to sign to get that cash withdrawal? Yeah, because you're creating a security with a face value on it, and that goes and sits in the asset account. Okay, so, and that's why credit cards have the signature on the back. Every time you swipe it, you're signing your name. Every time you enter a PIN number, you're signing your name. Okay, and it creates a security. So all that goes out of the account, really, you're authorizing the issuance of. Even when your bank just says, oh yeah, we decided to give you a bounce check fee of $45. You authorize the creation of those funds. And that's sitting over here as a security. Okay?
Yeah, sure.
So if you get your original checks back, does this affect how you fill out your tax forms?
If you get your original checks back,
Right. Without sending them to the Treasury and you're holding them, I mean,
if you're holding them, then there's no original issue discount. Now you haven't redeemed them, right? There's a redemption value to them, but
Right.
you haven't redeemed them.
so now, okay, so then say if I do send them into this place within, before 36 months, right? Does that affect how, and my account gets credited, right?
Right, but it may only be through Treasury. So
Okay.
I don't know if there's any recourse for you to actually get the funds back. You could give it a try.
But
Maybe send a couple of them to
Right.
Treasury with a cover letter saying, hey, send me the funds.
But are you supposed to fill out your 1099 or forms?
No, because there's
Any
no
diff-
original issue discount. At that point, the security wasn't withheld from you. They returned the security. So now it's up to you to redeem it. So you can choose to go get it redeemed. You're sure they're the originals too, right? Not copies?
This is just hypothetical.
Oh,
just,
okay.
You know.
Because I was going to say, I know they send out copies, but they usually make a big deal now if you want your originals sent
Oh,
back.
really?
Yeah. Because, like I said, probably something happened at the end of the last bankruptcy that this may have been part of the resolution of the new debt, was that they were going to hold these securities that we're creating and not return them.
But we don't know that for sure.
No, but that's when it changed.
Right.
It was at the end of the last bankruptcy. So I think it's interesting that that those events correlated, but it doesn't mean anything. Give it what meaning you will.
I just had a quick question. So just given the question, how much debt have I created, and that there's a 36-month period, is there a way to settle the debt prior to that, to whenever I started creating debt, like with having a bank, 15, 16 years old, having a bank account, checks, that's like, is there a way, to create a even, flat, because if I don't redeem that escrow from way back when,
Right. They
then
sold
there's a
it.
gap, right? It's got sold.
they
So
sold.
is that created? Then is that like complete?
Yeah.
Or is there a way to like redeem that to just? I mean, not like I'm going to get funds back,
No.
but is there a way to just settle the debt that I've created?
If there's open accounts, like for instance, if you had a checking account that you no longer bank through, or if you have an old credit card account or old loan account or whatever, those accounts are probably still sitting open with your security sitting in there?
Even if they're more than 36 months old.
Possibly, yeah.
So there's a way.
I
I mean,
mean-
again, without necessarily getting funds back, but just like taking responsibility for closing that escrow account to not create
Right.
debt in the world.
Right, and
That's
you
what I'm
can
asking.
do that, but
Okay.
that's not through the OID.
Okay.
That'd be with the A, the 1099A.
Okay, got it.
Okay, that'd be what you'd use to go close the accounts. Basically, with the 1099A, you're coming in and you're saying, hey, acquire that asset.
Great.
I'm acquiring that asset. And by you acquiring the asset, there can be no liability.
Okay.
So for instance, you've got an open court case, and you acquire the asset of the court case, There's no more liability. The court case goes away. You acquire the asset in your loan account. You know, let's say it's $100,000 over here that they loaned you, that you loaned them, actually. We'll get into that. So there's $100,000 sitting there. It's an asset. And so there's a $100,000 liability over here. You do an acquisition of this asset, which is the promissory note you created. That's a deposit instrument.
10 years ago.
Yeah, if the account's still there, now you're not going to get this money back.
No, I'm just saying.
You're just going to close this account. Yeah,
Just creating
Yeah.
not debt in the world.
right.
Reclaiming it, creating a complete.
Yeah,
zero
because
balance
getting rid of the debt.
bill.
Yeah, getting rid of $100,000 worth of debt in the world.
Okay, cool.
But if it's less than...
Wait, microphones. Where are we at?
Just to clarify, though, if it is less than 3 years old on that home debt, you can get the money back. If
What
you
ye...
may be able to.
Yes, but why would you? And how would you? See, it wouldn't be with the A, but what happened when you signed the promissory note? Isn't it just like a check? It's got a face value on it and your signature on it. Okay, so it's a security. So when you deposit it, okay, this is actually slightly different than an endorsed check because you actually made it out to the bank. You made the it's like as if you walked into your bank with a check from a different bank account, but it's your bank account over at Bank D, and you sign it and you deposit and you write it to your bank. You'd basically be just giving them $1,000, right? So that's what you did with the promissory note. You basically did a cash deposit, which created $100,000 in asset and automatically created the liability funds in the deposit account. You know what happened to those funds? They went to the seller. So basically you went in, did a cash deposit, they gave you the cash back, it went to the seller, but they're greedy. They're like, we're not going to just do this transaction for free. So they give you some bull about, oh yeah, it was really tough getting you that loan, so we're going to need some money down.
How about the whole amount?
And how much do they demand minimum for a down payment?
20, 30%.
The lowest, 10. Well, isn't that interesting? So if they got 10%, isn't that reserves? They just got reserve funds in the amount of 10,000. So what can they create out of that? Another 100,000. They got enough out of your down payment to create the entire amount again. Then they get you to pledge your property to you paying in on another security, which they're going to sell because of the future value in that. They're like, hey, we got this security that these chumps are paying in on. So your security may only be worth $1,000 a month, but you staple it to a couple thousand of those.
10 times.
Yeah, so they sell these bundled securities and they're like, hey, check this out. Do you want to buy this? This thing makes $10 million a month. Will you buy it for $100 million? And some other bank goes, yeah, we'll buy a $10 million a month security for $10 million. So now they get $10 million. So they already got the $100,000 back from the new deposits they were able to create when they took the down payment. Then they sell the security on the future values that's going to probably equate to, if not the full amount, close to the full amount of what they loaned you. But what actually happens is, and even according to the Federal Reserve, is you're the one creating the money. When you walked into the bank and deposited the promissory note, you authorized them to set up an asset here and a debt here. Okay, the debt is your deposit account. But because you were buying a house, they said, okay, well, we send the funds over to there. However they did it. Cashier's check, direct bank transfer, however they sent it there, that was the funds you deposited. But the security's still there. So remember, what happens now that this liability has been cleared out? This security's over in this column now. So they've got $100,000 over here that they can't do nothing with until they what? Sell it. And then when they sell it, they have $100,000 more in reserves. Okay? So, how much did they pay you for that? Huh? Yeah, they didn't pay you anything for it. So what's the issue price? 0. What's the redemption value? 100,000. What's the original issue discount? How much did they withhold?
Should we get into the interest or the down payment with that original issue or not?
Say it again.
If they're withholding just the $100,000 amount, but now they're charging us as creditors for the down payment
That has
and
nothing
the
to-
interest,
Right.
is that something we can get an original issue discount for also? Is there a way to create?
Well, remember, the payment in the form of a promissory note, that's an original issue discount that you're due, right? That they're withholding your security. However, haven't you been like a sucker making payments?
Yeah,
Okay?
yeah.
So all those payments you've made,
Yeah.
where do those fit in? They don't fit into this ledger, they fit into your other ledger.
Right.
Because you're writing checks out of your other bank account. See, this has to do with the mortgage company, these ledgers. But your ledger with your personal bank, remember, everything that goes out, everything that goes out. So
Yeah.
all the payments that you paid in on your house payment,
You're getting the interest
you
and
just,
the.
you just get it back from your OID on that bank account.
But
Has
you're still
nothing, you don't mention the mortgage company. The mortgage company has nothing to do with the payments you made.
So
And neither does the note.
right. So technically, roughly technically, you're getting the original issue discount back, the $100,000 from the mortgage company, and then also the 1099 OID from every payment you've made out, or at least just because there's a way that it's overlapping is what I don't.
Okay, run that by me again.
So if, for example, if this is the mortgage company we're talking about,
Right.
and we want a 1099 OID the mortgage company for the amount of the 100,000
Right.
and close the account.
Okay.
We'll close the escrow account, so we're getting the 100,000 back because we no, the escrow
You can
account, we don't need
close
anything
it.
back.
If you closed it, you come over here and you grab this asset, there is no more liability,
Okay,
right?
right.
Okay, so if you file an A on this, there's no more account. You don't owe anything.
Right, but say that's 3 years
But
down.
you also want to get the money back on the promissory
Well, no,
note?
but I'm
You can.
But yeah, like however that overlaps, because like say you've paid your 100,000, and it's been 3 years, so you're like, okay, I want to get that escrow account closed and the money back from the mortgage that I've, that note amount, say it's $100,000.
Mm-hmm.
Plus, I've now been paying out mortgage payments and interest and all that stuff every month, so you 1099 OID the bank as well
Right.
for those payments.
Everything that goes out of your bank account
Right.
just gets reported on 1099 OID for your bank.
Okay, but that's separate from the mortgage company.
Yes.
Okay.
So realistically, the only OIDs you would ever fill out would be for the bank for your checking account, the bank for your credit card, and if you have multiple credit cards and they're with different banks, there would be one for each.
Yep.
And then if you have a mortgage that you put a promissory note on, it would be the one for the bank that
bank with the mortgage.
you lent your money to. Yeah. Did you have a question? No.
If you had a corporation, can the corporation do this whole thing instead of the person?
Okay. The corporation doesn't have the ability to create a security. Who creates the security for a corporation? Yeah, the trustees of the corporation, right? The various officers, agents, those are the ones creating the credit.
So I wrote out $1 million worth of checks out of the corporation.
Right.
Is that me?
Yeah, it would be on your 1040. The 1099 OID would be with you, not your corporation,
Wow.
because you're authorizing the creation of the funds.
Yeah. Well, there was $1 million deposited, and then I wrote out the checks.
Yeah,
So I can OID
yeah.
personally.
Separate from your personal bank account.
Yeah, it would just be its own OID because it's a separate account. Even if they're at the same bank, you'd have to fill them. If you read the OID instructions from IRS, if it's more than one account at a bank, that's what that account number box at the bottom of the left-hand side is for. You put your, if you're reporting the amount on your business checking account, then it would go down there in the account number, the actual account number.
Okay.
And then, if you guys want, we can go over the details of the form. Any more questions about the flow of money?
Well, I have a question about the mortgage. You're saying when you usually sign, say, a mortgage, they'll have the amount of the loan, but then they also show like in 30 years it matures to such and such, you know, and it's, so how does that play into this? Because when you sign it, are you signing for the amount of the house being sold or the mature amount of the loan? Are you creating that also?
Realistically, now this is my own opinion. Okay, I'm going off of the Federal Reserve documents here for a minute. I believe that that initial 100,000 has nothing to do with the note you signed. It has to do with the credit application. It has to do with the credit application, because what happens is they come back and they go, oh, you got approved. What happened was they just got money. They just got paid. But they want to try to trick you into paying something totally different, and they want to get as much money out of it as possible. So they come up with the whole down payment, and we're going to have to add more interest, right? You know, we had to add a couple points of interest to it. And so they start changing what the actual application did. The application goes and grabs the funds necessary for the purchase of the house. The note, with all its interest and all that other, I believe that that's a separate security. Maybe not. They may be tied together. I know the application is a necessary part of this, though, because it's the application that has your Social Security number on it, and that's what's generating the credit. So without the application, the instrument becomes worthless.
I have a great question. Well, at least it's for me anyway. Okay. So you know the practice of buying and selling people's debt right now.
Right.
So if I signed over for a settlement company to buy $120,000 worth of debt, corporate debt for a company I was closing, my signature allowed them to buy that debt from me.
Somebody came and bought the debt from you?
Well, they took over all that debt for me, and
But it was your debt originally?
it was mine, right?
Okay.
Right?
Okay. So you assigned it.
I assigned it, but there was this whole legal thing with this signature thing I had to do online to make sure the signature was legit and all this stuff, right? And this has been like 5 months ago, and I was supposed to pay them like $300 a month to manage and negotiate my debt eventually for me, right?
Right.
And they said it may take up to, you know, a year or so because it takes a while, and your account's going to build in our bank account, and eventually all the accounts will be closed for you. And I haven't heard. I've actually stopped paying because I was going to write them a letter should they say I'm late on my payments, because I started learning about this. It's been 5 months. I've not paid them $300. I'm wondering if they used my signature and had the power of attorney to actually OID my $120,000 within their 3-year period, since I abandoned it.
Right. Actually, everybody who's a member of the United States has the authority to use your credit. Anyone with a fiduciary capacity. They use your credit all the time. You just didn't know it.
So good for them.
The county uses your credit.
Yeah.
Whenever you receive a bill that has a payment coupon at the bottom, they actually used your credit to generate those funds in an asset account. What they're telling you is, here's the payment coupon if you want to send us the liability to fill it. And if you did a banker's acceptance on that payment coupon and sent it in, what they should do, I'm not saying they will do, but what they should do is get rid of the asset. Or you could just file a 1099-A on that account, but if it's your electric account, you probably don't want to do that, because then electricity will disappear with the account.
Right.
That's not a good thing. But if it's an account that isn't a necessary or you want to close, by grabbing the asset, because it's your credit that creates these assets. Okay, here's something I didn't mention that I probably should have. No entities, public entities, can create credit. Only you can. Okay? Only people with signatures can create the credit, and that gives the banks the ability to create the liability on their books. But you're the one always depositing credits, always giving up the credits. They come back with the liabilities. Asset, liability side of the account. They're always over here. And you're always creating this over here. But all you spend in public is what's over here. So this is the debt side, and this is when you get Federal Reserve notes or you withdraw from your bank account, it's coming from over here. The asset doesn't get touched.